All right, let's get right into it. There are some really worrying signals flashing in the job market right now, and I mean really worrying. The data's pointing to a potential major recession around 2027, and today we're going to break down exactly what's going on. So here's the big question, right? It's probably the biggest puzzle in the economy today. You look at the markets, stocks are soaring, gold's up, even Bitcoin is hitting crazy highs. But something just feels off, doesn't it? A lot of people feel like a recession is just around the corner. So what gives? Let's dig in and try to figure out what's behind this huge contradiction. Okay, to get to the bottom of this puzzle, we've got to look at this massive disconnect, this gap between what the markets are doing and what's happening in the real economy, on Main Street. And there's no better place to start that investigation than with jobs. Yeah, this quote really nails it. Employment is the heartbeat of the economy. I mean, just think about it for a second. When people have jobs, what happens? They're earning money, right? So they spend it, they buy things, they go out, they buy homes. Demand goes up. The whole economic engine just works. But what happens if that heartbeat starts to get weak or irregular? Well, the whole system can start to break down. That's why it is, without a doubt, the most important thing to keep an eye on. All right, so let's start looking for clues. And when you look at the official data, you start to see some pretty serious cracks forming in the foundation of the job market. The trends? Well, they're all starting to point in the wrong direction. Okay, just look at this trajectory. I mean, wow. So back in 2022, we had that huge post-COVID hiring boom, right? And sure, everyone expected things to cool down a bit. That's natural. But this is way more than just a little cooling. The job creation numbers are just plummeting. They keep getting revised lower and lower, recently hitting just 173,000. We've gone from a red-hot market to one that feels like it's grinding to a halt. And it doesn't stop there. Here's the next big warning sign. For a while, the unemployment rate was falling, which was great. But now, it's not falling anymore. In fact, it's steadily ticking upwards, and it just hit 4.4%. Now, I know what you're thinking. 4.4% doesn't sound like the end of the world. And you're right, it's not. But it's the trend that's got everyone so worried. It's moving in the wrong direction, and that's a big red flag. And on top of that, let's talk about wages. Remember when wage growth was up around almost 6%? Well, that's dropped all the way down to 3.8%. And here's the kicker. Once you factor in inflation, the cost of everything going up, it means that for a whole lot of people, their real income is actually shrinking. Your paycheck just doesn't stretch as far as it did a year or two ago. Okay, so let's recap. Job creation is slowing down. Wages are stagnating. Those are bad signs for sure. But the most alarming piece of this whole puzzle, what I would call the smoking gun in this whole investigation, is the absolutely massive and accelerating surge in actual job cuts. Get ready for this number. In 2025 alone, just last year, employers in the US announced they were cutting over 1.2 million jobs. Let that sink in. This isn't just companies deciding not to hire as many people. No. This is a huge, active, widespread reduction of the workforce happening all across the country. And what's really staggering is the speed at which this is all happening. That 1.2 million figure, that's a 58% increase in layoffs compared to the year before. 58%. So the problem isn't just that it's a big problem, it's that it's getting bigger, and it's getting bigger fast. And don't think for a second this is just happening in one or two industries. Oh no. Look at this breakdown. Layoffs in the government sector, they surged by over 700%. Warehousing, where automation is taking over, up 317%. And even the tech sector, which is supposed to be booming, right? They cut over 150,000 jobs. It really makes you wonder, where are all these people supposed to go? So this brings us right back to that big puzzle we started with. How can the job market be flashing all these red warning lights while at the same time the stock market is just flying high? Well, the answer, at least according to the analysis we're looking at, has everything to do with the Federal Reserve. First off, let's just state the obvious. We're in the middle of a massive market melt-up. The S&P 500 is up, the NASDAQ is up, gold, Bitcoin, you name it, it's probably going up. If you just looked at the headlines, you'd think the economy was the strongest it's ever been. But this is where things get really, really interesting. Okay, so here's the core argument. This huge market rally, it might not have anything to do with the strong economy at all. The theory is that the Fed is basically doing something called QE in disguise. That's quantitative easing. They're pumping something like $40 billion of fresh liquidity into the markets every single week. And all that new money just artificially pushes up the prices of stocks and other assets. It creates this illusion of a booming economy, while underneath, the real economy is getting weaker and weaker. And let's not forget, this isn't just numbers on a screen. This disconnect has a massive real-world human cost. You've got hundreds of thousands of people losing their jobs, a lot of them to AI and automation. And for them, there's no safety net. It's not like they get a check that says, hey, AI took your job, here's 60% of your old salary. No, they're left facing rising credit card bills, trying to pay the mortgage, feeding their families, all while sinking deeper and deeper into debt. All right, so let's put all the pieces of this investigation together on the table. What do we have? On one side, we've got a job market that is clearly getting weaker. On the other side, we have a financial market that's being artificially pumped up with cash. Something's got to give, right? This kind of situation just can't last forever. And here it is, laid out as clear as day. The great disconnect. You've got two completely different stories being told at the same time. The market story is all about growth, rockets, and all-time highs, but it's fueled by Fed money. Meanwhile, the real economy's story is one of layoffs, shrinking paychecks, and struggle. These two stories are heading straight for each other, and they're on a collision course. So where does this path lead? Well, it's a pretty logical chain of events, really. Step 1, job creation slows and layoffs shoot up. Check, we're seeing that now. Step 2, real incomes shrink. Check, that's happening too. So what's next? Step 3, people start taking on more and more debt just to get by. And eventually you hit a wall. You can't borrow anymore. And that leads to step 4, people stop spending. And when consumer spending stops, that's when the whole house of cards comes crashing down. The analysis we've been looking at here is incredibly direct. It doesn't pull any punches. The conclusion is clear. What we're seeing right now is a major market melt-up. But the prediction is that it's going to be followed by a big crash, probably in late 2026 or early 2027. That's the point when the problems in the real economy just become too big to ignore anymore. So what's the big takeaway here? It's that the data from the job market is sending a really clear signal. Even while the markets are popping champagne, the actual foundation of our economy is showing major cracks. According to this analysis, there's a storm coming. So the only question left to ask is, are you prepared?